And in our top business story, DP World, one of the world's largest port operators, reported a 50% leap in net profit for the first half of this year, helped by the acquisitions of the Dubai's Jebel Ali Free Zone and Canada's Fairview terminal. The company made a profit attributable to shareholders of $608 million in the 6 months to June 30, compared to a profit of $405 million in the corresponding period last year. DP World's revenue for the first half was $2.09 billion, up from $1.90 billion a year earlier. In July, the company said consolidated throughput for the period was 14.6 million 20-foot equivalent units, down 1.4% from a year earlier on a like-for-like basis. In a statement released today, DP World's chairman, His Excellency Sultan bin Sulayem, said that when looking ahead to the second half of the year, the company expects throughput performance to improve and like-for-like financial performance to be similar to the first half. The port operator, which spent $586 million on investments in the first half, stuck by its forecast for full-year capital expenditure, ranging between $1.2 billion and $1.4 billion to finance investments in the UAE, UK, Canada, India and Turkey. In June, DP World said it had won a 50-year concession to develop a port project in Ecuador that would require initial investment of $500 million and would be conducted with DP World's local partners. The firm was also awarded in April a 25-year concession by the Cypriot government for the exclusive rights to operate Limassol Port in partnership with Cypriot government GAP Vasilopoulos Public. A new survey has revealed that almost 75% of Dubai firms are targeting new export markets, and 66% expect their businesses to grow its headcount in the coming year. The survey was conducted by Citibank and YouGov and polled senior staff members from 290 mid-market companies with a turnover from $50 million to $1 billion in Dubai, Istanbul, London and Moscow in early 2016. The reports found that 74% of companies surveyed in Dubai plan to open new international offices, and similarly, 74% will target new export markets as a means of growing their businesses in the next 2 years. It revealed optimism about economic prospects of the Asia-Pacific and the Middle East regions, but pessimism over Europe. 2 GCC countries were named in the top 5 favorably viewed markets for business expansion, with India, Canada, the US, Saudi Arabia and Qatar respectively making up the list. In the past 3 years, 4 of 5 in the survey sample had targeted new export markets, while 3/4 had opened new offices, with the Middle East the most popular location for both. Europe is the most popular anticipated location for new offices, and the Middle East most popular for targeting of new markets. Security solutions provider Kaspersky Lab has discovered a new wave of targeted attacks against 130 industrial and engineering sectors from 30 countries around the world, including the UAE. Using spear phishing malware, which is a term used to refer to a variety of forms of intrusive software as well as emails, criminals are hunting for valuable business-related data stored in their victims' networks. In June this year, researchers from the Russian company spotted a wave of spear phishing emails with malicious attachments. These messages were mostly sent to the top and middle-level managers of numerous companies. Dubbed Operation Rule by Kaspersky Lab, it is the latest among several campaigns that are supposedly controlled by the same criminal group. Security experts at Kaspersky Lab were quoted as saying that the emails sent by the attackers are made to appear as if they're coming from a bank in the UAE. The emails looked like a demand for payment letter from the bank with an attached document, which is actually the malware. The firm added that this group and similar groups are attacking companies indiscriminately. A spokesperson from Semantic Gulf also said that UAE's threat profile has worsened in a global ranking from 49 in 2014 to 41 in 2015, with the numbers of attacks originating in the UAE increasing over the last year. OPEC oil export revenue, which fell to a 12-year low last year, is expected to decline another 16% this year before rebounding next year. That's according to forecasts from the US government's Energy Information Agency. The EIA estimates that oil export revenue for the group as a whole will decline from $404 billion last year, its lowest since 2004, to $341 billion this year, before rebounding to $427 billion next year. The EIA said that the forecasts are based on oil production and domestic consumption, as well as oil prices and the impact on OPEC's members, which has varied widely. The countries cushioned most, according to the agency, are those in the Arabian Gulf with large financial assets, especially those which have increased production to record levels, including Saudi Arabia and the UAE, to alleviate the lower prices. The hardest hit are countries that have built up no financial buffer and have done little to diversify their economy's dependence on oil revenue, and may have also seen their production hit by conflict and/or mismanagement. This group includes Venezuela, Nigeria, Libya, and Iraq.